Hello, thank you for joining us. We will get started in just a second. All right. Good afternoon, and thank you for joining us today for the release of Desperately Seeking an Exit. Shell sells its Pennsylvania tax credits for millions, but still wants out. It's the latest report from the Ohio River Valley Institute explaining why Shell is unlikely to recoup its $14 billion investment in Pennsylvania petrochemicals development as global market headwinds continue to intensify. My name is Ben Hunkler. I am the communications manager with the Ohio River Valley Institute. We are a nonpartisan regional think tank working to chart a course toward clean energy, shared prosperity, and more equitable civic structures. We're joined today by report authors and Orvie senior research analysts Ann Keller and Kathy Hipple, who are both experts on the global polyethylene market and have written now several reports on petrochemical development in the Ohio River Valley, which you can find on our website at www.ohiorivervalleyinstitute.org. And in just a moment, Ann and Kathy will review key findings from today's report. But first, I want to quickly note that today's webinar is being recorded, and that closed captions should be available to you at the bottom of your screen. Please feel free to add questions, thoughts, or comments into the chat or Q&A box at any time. We will get to those at the end of today's program. And we will also send around a link to the recording, a copy of today's slide deck, and a link to both the report and a quick two-page summary later this afternoon. So please send me a chat if you need anything, and otherwise, Kathy and Ann, I will turn it over to you.
Thank you, Ben, and thank you everyone for joining us today. This leading off here, the desperately seeking an exit. This report, we actually started working on it earlier this year, and then in the midst of it, Shell announced their second quarter results for chemicals and sort of joined the rest of the industry in and expressing their distress at the condition of the industry facing the overbuild of capacity and some other challenges within their business, and made the comment that he did not think that Shell was the natural owner for the Monaca facility, and that they were seeking other alternatives, either a partnership or a buyer. And I think several of you probably read the Inside Climate News report that came out during that time that built on this theme and built on the discussions and the shape of the industry. And since then, of course, we waited for third quarter earnings from all the companies to kind of take a sense of where the industry was going. And unfortunately, third quarter hasn't really posted results that were much better than second. So we assume that the strategic process that Shell is going through right now is continuing. And every time that this plant is mentioned, it's mentioned in conjunction with the subsidy that was provided by the state of Pennsylvania, which for as far as I know, industry experts are considering probably one of the largest, if not the largest, subsidies that has been provided to one of these facilities in the United States. So it is interesting that in spite of that, even with those incentives, that Shell is looking at its options. So with this report, we delved a little bit further into the subsidies themselves and had found a couple of programs that we wanted to highlight this time and mention how they might affect both views of how the program has turned out as far as what it was intended to do and how things are going, and what might happen in the future in terms of what could happen with the facility and how the buyers might evaluate it. So Kathy, would you like to talk a little bit about the this had been something we've discussed previously, so we've updated
Yeah.
those numbers. So
So one of the things the Ohio River Valley Institute has done is looked at a number of economic indicators for the region. And they compared it to the whole United States, they compared it to the full state, and they've looked at, what we've just highlighted in this slide, 3 or 4 economic indicators, but the company has failed to deliver on promises of jobs and downstream growth. So looking at Beaver County, Pennsylvania, and the entire United States, it's really difficult to make a claim that once the construction phase ended, where there were a number of jobs that were created for the construction of this massive facility that cost $14 billion, not the 6 or 8 billion that was originally discussed, but the closer to 14 or possibly more. Once the construction phase ended, and most of those jobs were not even local hires necessarily, the economic indicators show that Beaver County has not fared well. The GDP has contracted by 12%, which is significant. Population has actually declined. There was an idea that this would draw more population to the area and more add-on businesses, more startup businesses would grow. None of that has happened. And employment has dropped by 13%. So in the terms of the promises of why a subsidy or a huge tax incentive was offered, the idea is that they would build out a petrochemical hub. They would have all sorts of what are called indirect or induced jobs that would be added on. That has not come to pass.
So just to review the subsidies that were designed to hopefully, or intentionally anyway, to kickstart the reestablishment of the ethylene industry in the northeastern U.S. Under what's called the manufacturing credit, which was enacted by the state of Pennsylvania. Shell has been awarded so far $90 million in tax credits that were originally intended to expand the industries upstream and downstream of this plant and kind of serve as the seed for the hub that was going to redevelop the industry in the region. So far, it's sold about $30 million of the credits because apparently they didn't need them to offset their taxes. And as this point, most of them have gone to insurance firms and companies that are not related to petrochemicals manufacturing, which was not also the stated intent or the desire of the community. The credits that were awarded for 2024 were announced in this year, and that amounted to 57 million, which is more than the other 2 years put together because the plant was finally up and running at relatively high rates. And we have not yet seen the disposition of that money, but 57 million is essentially enough to cover the entire direct payroll of the plant for 2024. So it's a significant amount of money. The original intent, going back through the files of the statements that were made by the various politicians and local economic development groups that were promoting the subsidy, the resource manufacturing tax credit, which awarded Shell a tax credit equivalent to 5 cents a gallon of the ethane that they purchased to put in the Monaca plant, was to assure that the petrochemical supply chain would build out in Pennsylvania. And originally, these tax credits were to give them a credit against their existing tax liabilities and were not intended to be a direct payment of taxpayer dollars. And the stated intent was that when the cracker was up and running and the spin-off industries are in operation, the idea was that job growth would occur beyond the scope of the original plant facility and that tax revenues would increase. You'd have withholding on wages, you would have additional sales taxes from these businesses that were not exempt from them, and you would have all the associated taxes that the spin-off industries would pay. So that was the original deal. But so far, what's happened? So between the intent and the final legislation, somehow the credit was modified so that if Shell didn't need the credits, they could be transferred to upstream or downstream companies and related businesses within the Shell family, or companies in similar businesses that were outside Shell. And at that point, since they were outside the Shell family, the legislation was modified and they were allowed to be sold. So in essence, they are monetized and they are taxpayer money now, because Shell's effectively being paid by an outside party for these credits. And so far, they've reported the disposition that you're seeing here in the exhibit. And although the company that acquires the credit is supposedly only allowed to use it to offset 50% of their taxes, these companies were generous enough to pay almost 100% of the credit that was transferred to them. So effectively, so far, $30 million cash from the taxpayers' funds. And here are the locations of the firms. One of them, or like $28 million, was an insurance company. It is headquartered in Pennsylvania, so it's within the state. Obviously would need tax credits, I guess, against Pennsylvania taxes, so that would be beneficial. Some of the others went outside to firms in Connecticut and New York. There are some intricacies in the Pennsylvania tax code that could provide benefits to those out-of-state firms if they had business within Pennsylvania, but it's not really our mission here to delve into the minutia. It's just simply to say that of the money that was intended to offset the credits in return for expanding the hub businesses around the petrochemicals industry, ultimately they were turned into cash and moved to other industries. But when the legislature did enact this provision, they did put in a mechanism to revisit the decision and set a trigger point, which turned out to be the first 10 years of the program, which was 2017 to 2027, and require that whoever is currently the owner of the manufacturing credits, which can be inherited if Shell does do something with the plant, whoever the owner of the credits is required to file a report that covers the first 10 years of the program. And it has a fairly lengthy listing of requirements that are supposed to tell the state assembly how many jobs were created, what industries they were in, and how much tax revenue was received from these industries. And the rest of the provision is an evaluation metric that says, let's look at the revenues that we got and post that against the tax credits that that were rewarded or awarded by us, and take a look at the math, and if necessary, make recommendations to change the program. So if the assumption is that whoever walks into the plant business is going to automatically acquire these tax credits for the next 10 years or so, they need to review this provision, because it does introduce some uncertainty around what will happen next, depending on how the money is dispersed for the next few years. The other issue that was actually mentioned by Shell CEO when he said they were not the natural owner of the plant, which probably struck some people as odd because Shell has a chemicals business. It just isn't in Pennsylvania. This particular plant was intended to be joined by others. We know that PTTGC in Thailand had proposed to build one in Ohio. Braskem had proposed to build one in West Virginia. There were a number of other projects that were floated that didn't come to fruition. So the group of plants and the interconnections between them that were anticipated to sort of mimic the existing assets of the Gulf Coast didn't really happen. And the Shell plant is the only one of its kind in the area. And so if you have a standalone facility where you've got a production unit, which is the ethylene unit that makes the ethylene feedstock, tied to a downstream unit that makes the polyethylene, which is the pellets that go to the end users, you have an additional additional challenge placed on you operationally if something happens to one half of the plant or the other in maintaining a constant throughput and constant operations. Whereas on the Gulf Coast, the plants are interconnected, and if one plant has operational issues, they can store material or they can get material from another location, and it makes it easier to maintain. So there were efforts made to put in additional assets, such as a storage facility, so that it would expand the plant's ability to weather operational upsets, but those projects really didn't get off the ground. The other piece is the challenge now on the feedstock cost advantage that was a big attraction of locating a plant in Appalachia to begin with. The gas in Appalachian production contained a relatively high concentration of ethane, and producers were encountering challenges in developing their oil and gas reserves at the pace that they really had planned to, because of the need to extract the ethane and meet gas transmission pipeline qualifications. And Shell was originally looking at building this facility to use a lot of that ethane, which was essentially trapped within the region, and looking for a home of some sort. The problem is that by the time the plant was sanctioned and by the time the construction was completed, producers had already funded other options to move the ethane to the Gulf Coast, to move it to the East Coast for export to Europe, and to move it to Canada, where Nova Chemical has expanded their facility considerably to use the ethane. They had the advantage of having underground storage and pipeline connections, so they were able to use those assets and attract production that might have otherwise been a target for Shell. So that effectively raised their feedstock costs somewhat above what they had originally planned. Although ethane is still a very attractive feedstock, and companies that use ethane to produce ethylene are very competitive in the global market. It just introduced more challenges for other companies looking to locate in the region, because now the feedstock had ways to move out. The other problem is definitely an economics issue. The industry, the ethylene industry, is the primary chemical industry that drives a lot of activity and supports a lot of the products that we use in everyday life. The rise of shale gas and the considerable increase in supply of both gas and petrochemical feedstocks created effectively a super cycle for the chemicals industry, which resulted in massive building of capacity for ethylene and polyethylene production. But unfortunately, that capacity boom occurred both here in the US and in China. China was the designated market for a considerable amount of the US ethane and ethylene, because of the demand there due to their real estate boom, population growth, and as we know, the boom in the export markets. But since China built up their own capacity, that created a challenge for US companies that were targeting that market, and has resulted in pressure on prices. The net result is that analysts in the industry are saying that the overcapacity build this time is so extreme that they're looking now at shutdown scorecards to bring capacity more in line with the market share. And Shell's timing was definitely at the very end of what's called the super cycle. So it's kind of facing an uphill battle in that regard. Kathy?
So one of the things we wanted to delve into is what would happen next. And we'll spend the rest of our time, and thank you all for joining us. On top of the global headwinds, each of the other potential buyers, and we just looked at a smattering of them, it certainly is not conclusive, but these chemical majors are struggling with their own financial challenges. One other thing that did not make it into our slide deck is that this is a standalone facility that's a PE. So there are some specialty chemicals producers that will be better positioned, but this was destined to be an ethane cracker that would produce only polyethylene, which is a commodity grade, and that's even at more risk than the rest of the petrochemical industry that is, as Anne pointed out, facing a not even a once in a generation, perhaps. Reading through industry observers, they have never seen anything quite like this. So they're not saying this is a cyclical bounce, like every boom and bust. When does the next boom come? As we said, there are scorecards of which ones and which continents will be permanently shut. So the look back provision is one potential deterrent for a future buyer, but each of these potential acquirers or partners of Shell will face the same issues that the whole industry is facing. So we've just put together a potential list. PTT Global spent many, many years clearing land, buying land across the Ohio River, getting roughly 70 million from Jobs Ohio, 20 million of which was returned to them. But they never actually reached FID, and they kept saying, next year, next year, next year, we will actually go forward and move forward with it. And there were photos taken with all sorts of politicians, and there was great fanfare. It's possible that they did not want to put up what they thought was going to be 10 billion, that if they could get it at a low enough price, if Thailand is still interested, this is a Thai-owned company. It's possible they will come forward, but since they opted not to build it themselves, they're moving in different directions with either recycling efforts or other things. We would put that as less likely. Braskem, which is a Brazilian company, is financially distressed at the moment. They're talking about restructuring their debt. They seem to have been the other, we talked about there were 3 potential cracker plants that were somewhat far along. This was to be in West Virginia, again, along the Ohio River Valley, but they officially abandoned their project in 2019. Given the state of their finances, we consider that highly unlikely, even though they had looked at it at one point. One of the potential acquirers that we think is potentially somewhat likely, and this might be important for some of the people on this call, is Formosa. Formosa, while it has weak financials and its revenues have been declining since 2019, they have shown tremendous interest in expanding their petrochemical capacity, primarily along the Gulf Coast. They have been trying to open a facility in St. James Parish in Louisiana, the so-called Cancer Alley. And they have faced tremendous obstacles from legal lawsuits and environmental reviews, and an activist community, St. James Rise, or Rise St. James, has pushed back and said, enough, we have so many refineries here, we have so many petrochemicals, we have such a high cancer rate, and they have stopped this along the way, and litigation is ongoing. I don't know the exact state of it right now, but it may be somewhat appealing to them that instead of building something and facing local opposition, if they could walk in and get a turnkey facility that is operationally up and running, despite the niggles and despite the, that was what the CEO said. They'd had some technical niggles that they were working through, but they've had a fire and they are still not operating at full capacity. That said, at least it's a built facility, and Formosa might find that very attractive. Lyondell is facing really, really poor financials. If anything, they're looking to divest, and all of their financials, first quarter, second quarter, third quarter, talk about we're looking to divest. We've got to reduce and bring down our debt. They do have the operational expertise. They're a global petrochemical company, so they have the strategically, conceivably they could, and they have the operational expertise. We just think their financials are too weak. Similarly, Ineos, which is a European company, they are set up to import ethane from the East Coast. So it could be a strategic asset for them. But the dire financials, probably the worst part of the world, and correct me if I'm wrong, but the European petrochemical industry has been in terrible shape. The CEO of Ineos has been asking government in Europe to step in and help protect their industry. He's talked about dumping. He's talked about how it's very important that they keep some semblance of their petrochemical industry in Europe so they don't have to import all their petrochemicals. It's a private company. We don't have insight into their financials, but we have heard that they are in deep trouble. Dow Chemical, their revenue, if you just do a chart of their revenue declines and their profit declines. One of the analysts that just put something up on LinkedIn recently said they should shift from commodity volume, which is commodity, the PE, the commodity PE, to a specialty chemical. And that way they would be differentiated, making something else besides just PE. That's in any kind of a downturn, the commodity product is usually the most affected negatively.
Yeah, one of the things that we were looking at, sorry to break in, on the scorecard here would be responsive to the Shell CEO's comment that it's easier to have more optionality and provide more benefit from this particular commodity if you have multiple facilities. It was that single facility issue again. And the companies that we're talking about here do have multiple facilities. They just aren't located in the region. So that was one of the reasons that we put them through this screen, in that one of the benefits of having this plant was that it was closer to customers, but the downside is that if you have operational problems, if you have turnarounds, if you have issues that cause delivery challenges, if you have multiple facilities, you can bring material in from other locations, and if you don't, they need to have contracts with other suppliers. So that was why we were focusing on this particular group.
Yep. So getting back to our last two or three, BASF, a huge German conglomerate, it's the world's largest chemical producer. It seems to be in better shape than its competitors. If they had an interest in moving into North America and expanding their footprint, and they might believe that the ethane, the cheap, abundant ethane, it still is cheaper than naphtha. So there still is a feedstock advantage. Maybe they feel they could succeed where Shell has not. But they are, again, cutting costs in Germany due to their own financial hurdles. And finally, we did look at Exxon because they were a company that had started to look into real estate along the Ohio River Valley with the idea of opening an ethane cracker. There were rumors. They scrapped any plans officially back in 2019, or perhaps even later they said, we're not doing it now, we're not planning to do it. It appears that they are prioritizing specialty chemicals like an ethylene oxide instead of, again, PE, the commodity grade. And they have delayed their own polyethylene project in the Gulf Coast due to what they call difficult market conditions. And we would put Chevron in basically the same situation, even though, like Exxon, they've had strong financial performance in the last couple of years. But management for that also appears to be prioritizing specialty chemicals. Chevron was in the Appalachian, the Ohio River Valley. They had gas assets in 2019, but they took a huge write-off and got rid of all of them in what an industry has described as a fire sale price. And then finally, everybody knows Warren Buffett purchased the OxyChem, which was part of Occidental Petroleum. He'd had an interest through his firm in the combined Occidental Petroleum plus OxyChem. we don't believe that he had any, or his firm had any big, strong interest in the petrochemical industry. We think this was a one-off strategic opportunity for him, a strategic investment opportunity, rather than a bullish view on the petrochemical industry. So it could be one of those, it could be none of the above, it could be a completely separate, unexpected buyer coming to take Shell out of its into its long sought after exit. And just a reminder, they did mention this in their first quarter earnings, their second quarter earnings, and then their third quarter earnings, which is why we titled the paper "Desperately Seeking an Exit."
Kathy and Ann, thank you so much for this presentation. We welcome any questions, thoughts, comments in the chat or in the Q&A box. Um, to get us started, Ann, I've got a question for you about the implications of Shell selling off its tax credits that were designated for local petrochemical development. Why should Pennsylvania taxpayers care about this?
Well, originally, if the intent on the part of the taxpayers was to fund an expansion of the hub or an expansion of industry, as opposed to just to replace the zinc smelter that was on the site, they would have said this is definitely, I guess it's an incentive that we could support. But then if it becomes an issue of just getting money, literally, this doesn't even offset the taxes of a business that was in the orbit that they were originally talking about, then it's almost like just a funds transfer. This was, tax revenue that's gone, that's not serving the local community at all.
Thank you. Kathy, do you have any thoughts on what a sale or partnership would mean for folks living near Shell's ethane cracker site?
I I don't have insight into that. I do, maybe answering a different question. I do think that sometimes when there's a public announcement, we did a little sidebar in the report for anybody who's interested in a look back in history about the ethane storage hub. And the idea was that the federal government was going to give a tremendous amount of backstopping in the form of loan guarantees to build an ethane storage hub. But instead, they did offer this, and there was a lot of talk. At one point, China was going to invest $85 billion into this as well. But the bottom line is the private sector did not come forward. So that quietly died on the vine. And I think there's something similar where even though Pennsylvania had this idea of building out a manufacturing hub, a petrochemical hub, they offered their largest tax credit in state history. The private sector, it's not enough for the private sector. The market signal has to be that it's got to be profitable and operationally sensible. It's not enough just to throw for the state government to throw money at it. So I don't have a sense. One would hope it would be an operator. I don't know that the community feels that Shell, with all of its notices of violations and the fire and the idea that I don't think the citizens were quite aware of what would happen when that petrochemical facility came in, but the fact that it did not bring the economic benefits promised and or expected, or some of the studies, we've also done reports, some of the studies that promised these economic benefits were actually funded by Shell. And there were tremendous academic flaws in these studies. So it's little wonder that the economic benefits have not come forth.
That's a great
The
point.
other thing is the obvious question that's sort of the elephant in the room is, well, if they're not successful in doing something doing a transaction within a certain time frame, would they look at shutting the facility down entirely? And there's we've gone into that a bit in the report in terms of its positioning. And when you
Hmm.
look at the analysis, the bottom line is that ethane-based ethylene crackers that are modern and this generation of so-called greenfield projects, even though it's not located in the Gulf Coast, it does have a competitive advantage against, for instance, an older European cracker, which is why you're seeing all the news headlines about those facilities shutting down. They simply cannot compete. 47% of the polyethylene that our facilities make in the United States goes to the export market, and the export market would not accept it, tariff or no tariff, if it weren't competitive with the material they could get somewhere else. So this facility is in that class. The issue is that as we dug into the tax credits, future partners, buyers, whatever, need to be aware that what you're getting is really your basic ethylene commodity polyethylene facility, and not necessarily to count on this additional benefit from tax credits, because when you add up the numbers, so far it amounts to about an 11% improvement in their margin from this feedstock subsidy. And for those in the industry that track these things, that's very big, very big.
And answering, it looks
Mm.
like Deb's question, Shell is not afraid to take write-offs. One thing to note is the decision to move forward on this plant was made 2 CEOs ago. So we've got the new CEO coming in and having a decision that was not just made by his predecessor, but 2 predecessors ago, where the world looked very different. I mean, it was in the middle of a chemical super cycle at that time, tremendous enthusiasm. The timing just couldn't have been worse for Shell. So would they take a $14 billion? I mean, I used to keep a running list of these massive write-downs that Shell took. So they're not afraid of a massive write-down. They will be taking, in my view, a write-down on this, a massive one. I don't see anybody else coming and making this. But to Ann's point, it is a modern facility. At some price, somebody will likely want it. So I don't see it closing down. Um, Depending on your definition of stranded asset, one could say it will be a stranded asset, but I do believe it will still continue to be operational.
Thank you both. Again, please feel free to drop any questions, comments in the chat or the Q&A box here. And what can we expect to see once the Pennsylvania Resource Manufacturing Tax Credits look back provision triggers in 2028? Do you have any thoughts about what might happen then?
There's a classic, it depends, right? So far, we know the disposition of the first 30 million,
Hmm.
and to base conclusions on what happens next for the next, what will it be, 3 more years of what Shell is hoping, I'm sure, to be relatively full operations is, is basically speculation. So, they may have something may be going on, and they may be having plans for some sort of development. I guess you could call it a mixed blessing. The good part about not restricting it specifically to the petrochemical industry per se could mean that the credits could be used to support something else in the region. No idea that they would be or whatever, but until we see the recap of what's been spent, I think for this year, the 57 million, which is a lot of money, it's really hard to say that it won't go into something that might be more representative of what the thinking process was. It's just that it is a larger credit than was originally anticipated, and it wasn't expected that Shell would be the determiner of how it would be spent. So totally.
Thank you. We've got a question from Cynthia in the chat who asks, can you put this in context for us, given a presidential administration and Congress that are throwing massive subsidies toward the petrochemical industry? Does that make a significant difference in Shell's planning and trajectory?
Um, I will make a huge leap out and say that I'm not familiar with what those subsidies might be, to be honest. On the Gulf Coast, the only The only thing I guess you could define as a direct subsidy would be the fact that very few of these facilities pay property taxes, or they get very substantial exemptions from local property taxes for many years when they're put into service. And that's kind of like table stakes, I guess. Pennsylvania's, like I said, was large and unusual, and in many ways, the fact that it was directly tied to feedstock, the fact that it was ultimately capable of being monetized without a lot of restrictions around where the money went. That one I can honestly say that I've seen. Uh, so I guess from the climate side, I suppose you could say that there's a lot of relaxation that I'm hearing about environmental issues when companies are looking to permit or build new facilities. But beyond that, I'm not familiar with what subsidies there are other than what you typically give big business, write-offs on capex and that sort of thing.
Yeah, so Cynthia just clarified in the chat that she was talking about liberation from pollution controls
Yeah, that
in that way, right?
definitely.
Yeah.
Yeah, yeah, yeah. Yeah, that is not that's not great for the surrounding community. The other part of it, though, is that is not necessarily number one in the company's decision about what to do around a facility.
Mhm.
Oh, great, we can start running it poorly or whatever. So that makes such a big difference that we'll keep it running. That's not really in that calculus. So,
All right. Well, again, please do check out the full report. It's on our website. I'll drop a link in the chat here again. We've also got a quick summary version with some key findings and talking points. We will send around a link to this recording later this afternoon. Also, we'll send around a copy of the slide deck. Um, and again, if any questions come up later, thoughts, concerns, please send them our way, and we'll be sure to get back to you. Um, but again, thank you so much for joining us today, Kathy and Ann. Thanks for the presentation and for the great report. And we hope you all have a great afternoon.
thank you, everyone. Thank you,
Thank
Ben.
Right.
you. Thank you, Ben. Thank you,
Mhm.
Anne.